Until so far, you have only direct plans. Are there no plans of introducing regular plans?
Never say never is one thing that I always believe in.
The Indian mutual fund industry is not very new for BlackRock. So what is something different that you're going to try this time?
First and foremost, in the previous joint venture, there was no Aladdin.
So Jio typically enters any market with a disruptive mindset and to become the leader. Is it going to be leveraging Jio's network in the tier 2 and tier 3 cities and below that?
I've been asked this question before. I see.
Today we have Mr. Sid Swaminathan, the Managing Director and CEO of JioBlackRock Mutual Fund with us. Before joining JioBlackRock, Sid led the management of $1.25 trillion worth of assets at BlackRock, a figure larger than the entire Indian mutual fund industry. In this episode, we explore how the powerful combination of Jio's extensive local distribution network and BlackRock's renowned asset management expertise is being leveraged. Sid shares insights on upcoming product launches, how technology will revolutionize stock selection and cost efficiency at JioBlackRock, and how the AMC aims to become one among the leaders in the industry. Let's hear it from him. Hi Sid, welcome to our show, Speaking with Stalwarts. It's a pleasure to have you here and I'm excited to have this conversation.
Great, thank you for having me. Happy to be here.
So you've spent close to 20 years in the UK. What made you come to India?
Good question. So I was quite happy with my job in the UK. Things were going really well. And I was at BlackRock, as you might know. And this joint venture got announced. And I still remember the day. It was my dad's birthday. We were all together in the UK, 26th of July, 2023. The announcement hit the news and my family is like, oh wow, BlackRock's doing something in India. We all got very excited. And I got very excited personally because for me, having been at the firm for nearly 20 years, the opportunity of us, building something from scratch in India at this point in time of India's journey, from an economic perspective, was super exciting. So I got, excited and I said, hey, how can I help out? I was asked to come and help out with a few projects. And then one thing led to another, and I was here in March 2024, starting to build the company. So that's, in a nutshell, what got me to India.
So what opportunities that you see here that made you leave your comfortable job in the UK and come to India?
I think the opportunities are, firstly, from a markets perspective, I think they are phenomenal here. There's plenty that is going right if you look at it from a macro perspective, whether it is the GDP growth, productivity, demographics, all of these are working in India's favor right now. So there's tremendous tailwinds. And then when you look at more of the micro elements, there's also a lot of potential there. So participation of the retail investor in markets is on a fantastic trend. And we are still just scratching the surface. Even though the trend is positive, there's such a long way to go. And if you look at it as percentage of GDP in, let's say, the mutual fund industry, we're still in the late teens, maybe hitting 20% here, whereas in the UK, it's over 80%. In the US, it's above 150%. So that growth of the industry is tremendous. So we're seeing this, financialization of savings happening, which is very exciting. So for us to start out a joint venture with Jio and BlackRock to help grow that market, firstly, and then be a participant and a beneficiary of that growth is extremely exciting. So from a professional market standpoint, that's kind of what drew me to this. And then from a more personal standpoint as well, I'm Indian. I was born in India. My family is still here. My wife and kids weren't born here, so the opportunity to bring them and have them experience Indian culture also was I'd say, another attraction. And that's gone really well. So I'm really happy with how both of these things have progressed so far.
So was this the thesis behind starting JioBlackRock Mutual Fund? Like I'm talking about the management.
Yeah, so I'll take a step back if that's okay. Start with the joint venture itself, right? So the joint venture is actually multiple entities. And the objective and the mission of that joint venture is really to democratize investing, make personalized portfolios easier, affordable, and more accessible to more and more people in India, right? So that's the vision and the mission. And the way we're looking to realize that is through multiple entities. So we are here talking about the mutual fund, which is the asset management company, and then we have also announced and are in the process of building up our wealth management company, and we've also announced the brokerage. So that's the sum total of it. So within, let's say, the mutual fund itself, we firstly want to ensure that everything that we're building and delivering is aligned with that broader vision and mission. And we really want to make sure that from a product perspective of what we come to market with has a unique value proposition for the segment of the, let's say, the customer base that we're looking at, right? So we've done a lot of work on firstly understanding and segmenting the customer base, so institutional, retail, and even within retail, looking at the different elements of the retail segment, and then making sure that the products that we launch satisfy a need, firstly, and secondly, bring something that is unique and differentiated to the market, because the market is in a healthy space right now. We've crossed 75 trillion in assets, there's 50 AMCs, so we want to make sure that whatever we bring to the market is unique in some way, shape, or form, and I'm happy to kind of go into more details with you on that if you want.
Got it. I'll come to the differentiated part, but what exactly is your strategy to establish your presence in a market that is already, dominated by strong incumbents?
Yeah.
Apart from the product perspective, like I'm sure there would be something around distribution as well.
Yeah, sure. Yeah. Firstly, yes, the market has a lot of strong incumbents. That's a sign of a very healthy market, so we like that. But also, let's keep in mind, to the point I made earlier, this market is expected to grow significantly. So the macro and the micro tailwinds that I was talking about earlier, we think that this could be 2.53x from here in the next 5 to 7 years. So there's tremendous growth potential. There is space for everyone, right? I think that's the starting point. So it's not necessarily just about trying to capture market share from existing players. It's about helping grow the pie and then be a part of that growth, right? So that's how we look at it. So the how. So the question is the how, right? So the how is going to be for us, firstly, as I said, through differentiated products, because one way to also help grow the market is to actually offer something different in the market. So we're spending a lot of time thinking through, our products and how can they be differentiated to the end customer. So that is one. You talked about distribution. I think that's also an important area for us to cover. And we, as you know, at our launch, have chosen to go with a more direct approach and leveraging a lot of the digital ecosystem, right? So if you allow me some time to explain
Sure.
that, we see tremendous potential already in the fact that more and more people in India are getting very, very comfortable with doing a lot of their finances on their phones, right? And that is a trend that is stronger here than in many parts of the world. And I think that's multiple reasons that cause that. One is, let's say, behavioral. People just are more happy doing it, but also the ecosystem is much more evolved. So the tech stack that is in place here, I think, is much more advanced than in other countries. So I think the combination of those two is super powerful. And the fact that we've partnered, the joint venture is a joint venture between BlackRock and Jio, and with Jio having that kind of presence in that space, in the digital space, with an understanding of the Indian consumer, really gives us the confidence that when we launch, that's the first go-to-market strategy of how do we leverage this trend that we see already becoming very strong in India of digital first, people using their phones, along with the strengths of the joint venture partner to really maximize our ability to reach the customer. So I think it's a combination of both. You need differentiated products, you need different ways of reaching the customer, and that's how we're approaching our launch.
So Jio typically enters any market with a disruptive mindset and to become the leader. is it going to be leveraging Jio's network in the tier 2 and tier 3 cities and below that? That is what you're banking on?
Yeah, I've been asked this question before. I see what we are doing here as a series of micro disruptions that I think over a course of time leads to a bigger disruption, right? So that's how I would phrase, the JioBlackRock entry. In terms of access, yes, right. The ability of the phone is that it can be everywhere. So as long as people are willing to use their phone, it doesn't matter if they're in tier 1, tier 2, tier 3, tier 4. So that's great. However, that requires education, right? So I think a lot of the focus needs to be on delivering the education, which I think the industry is doing a very good job of already. So we are here happy to be a part of that and help amplify that in the sense that we can also provide a slightly different tilt to that education because we have got a different, let's say, background coming from BlackRock, a global asset manager launching in India. So do more, but in a slightly different way. I think that's important. And then through that, we have to build trust, right? So I think those are the two most important things, right? I think once you build and help build the knowledge and the understanding, and then you build trust, once those two things happen, along with this trend of people being more comfortable of doing things on their phones, then I think the geographical lines are blurred, right? And I think that's the power. So I think we need to focus a lot on that, which will then really, I would say, catapult our strategy.
Got it. So until so far, you have only direct plans. Mm-hmm. Are there no plans of introducing regular plans and leveraging the distributor network?
The way I see it, is, as I've said, at launch, our strategy is very clear, right? And we've been very public about that. And the reason for that strategy also I've tried to explain as to why we think that given who we are and given who, let's say, the joint venture partners are, why this makes a lot of sense at launch. We're also very much in our launch phase. This is still phase 1. We've been in the market for just over 2 months, and we're learning a lot, right? And in terms of how customers are responding to our funds, to our strategies, messaging, all of that, we're learning so much with every NFO that we do. And the way we see it is that we will adapt and evolve our strategy based on what we actually learn from the experience. So never say never is one thing that I always believe in. And it's all about how we believe the strategies will build up towards our goal of delivering personalized, accessible, affordable investments to the people of India, right? So if at a later stage we believe that we need to amplify, supplement a distribution strategy with another distribution strategy, that's something that we would look at that point in time. But phase 1 is very clear, to your point.
Got it. So the Indian mutual fund industry is not very new for BlackRock. They have been here earlier. So what is something different that you're going to try this time?
Yeah, first and foremost, the big differentiator for this joint venture is the presence of the technology platform Aladdin. So in the previous joint venture, there was no Aladdin, and I think Aladdin allows, a lot has been said about it, but I think in essence what Aladdin allows firstly JioBlackRock to do is to innovate and manufacture portfolios at scale, right? So the ability to innovate and manufacture at scale is unique, and I think the strength of the platform, because it is an end-to-end platform that covers everything from, let's say, the start day positions to operations, risk, portfolio management, trading, compliance, everything is in one place. So I think that makes it a big differentiator in this iteration, right? And secondly is the digital first approach that I've talked about, is leveraging the overall digital ecosystem. I talked a bit about how we use the Jio ecosystem already, but that's not the only digital ecosystem here. We're also working with other digital platforms that have been, very, very powerful in terms of how we get our message and our funds to the end customer. So that's also unique in that it is a very much a digital first approach.
So, since you're talking about Aladdin, how does it help in building better passive funds or active funds? If you can just tell, like, how does Aladdin help from a typical AMC setup in building better passive products and active products?
Yeah, great question. And firstly, so Aladdin on its own is, let's say, set up and built so that it can actually support many, many different investment styles, asset classes. Because if you think about the volume of assets that are managed on Aladdin, like BlackRock has over 12 trillion that's managed on Aladdin. But then globally, that number is well north of 20 trillion because it's also used by other asset managers around the world. So all different styles of investing are supported firstly. But let's zoom in on JioBlackRock, right? And how does it make a difference to us here in India? So if I think about the index business first, and I very specifically call it index and not passive because we truly believe that there is nothing passive about index investing, right? The objective of index investing is to track a benchmark and deliver as close a tracking difference to that benchmark as possible. And you actually need to be very proactive to do that. So it's not a passive action. So the information that we have in terms of transaction costs is a big influencer, right? So liquidity and transaction costs. So if you think about tracking a benchmark, so for a fund manager, the biggest, let's say, challenge there is going to be the transaction costs that are incurred in tracking that benchmark. So the ability to have the view on what could the tracking error or a tracking difference, more importantly, so which is the post realized transaction cost, be for, let's say, a rebalance event, which is typically the biggest event for an index fund. Having that at your desktop in your tool in advance of putting the order through is super powerful. And then having, let's say, the liquidity parameters for the baskets of stocks that you want to be trading available in front of you for a dealer is super powerful. So that means that the fund managers and the dealers are able to execute rebalance strategies with a very sharp view of minimizing total impact, which again results in better tracking, which means that the end customer is getting as close to the index return as possible. That is the objective. So that's kind of how it plays a differentiating role. Now, the fact that it can do all of that and still scale is very important, but I'm talking about it more from an end customer returns perspective is where the big differentiator comes.
So since you said that Aladdin is being used by other asset managers as well, so won't it be accessible to other asset managers in India?
It can be, and that's not a bad thing, that's a good thing. So yes. Again, internally Aladdin is referred to as the language of portfolios. So more and more people that speak the language, the better it is for the overall ecosystem. So there are no issues with that. I think what differentiates JioBlackRock is the fact that the entire investment process is Aladdin native, as we call it, that everything's designed around Aladdin. So the people that we hire, the processes that we put in place, everything's designed to optimize the use of Aladdin, which again others can do and many do it, but it takes a lot more time to do that. Whereas we are what we call Aladdin native. So that's a big differentiator. If I can step back into kind of the how it matters to the investment process, right? So I've talked about how it helps minimize transaction costs and tighten tracking error. We're also able to pull in in advance information on what are the upcoming changes in the different indexes. So that comes in an automated feed, and that is provided live to the fund managers in a very, let's say, intuitive view with regards to their portfolios. And that allows also fund managers to prepare for big rebalances that might be coming in the future. So all of these all make very small, let's say, differences, but in index management, every little basis point matters, right? So that's what we are really focused on. And we call ourselves like index nerds in that sense, that we want to try and minimize every basis point of tracking difference. Now, switching gears to active, right? And again, I will zoom in very specifically to how JioBlackRock is approaching active. And we are launching with what we call our systematic active equity strategy. And that is a very proactive decision that we made. We've looked at the space in India in terms of active equity specifically, which is the largest part of the market, and really looked at what do we have already at BlackRock that is very differentiated and complementary to the market that it already exists. And the systematic active equity franchise, which has been running for 40 years, so they're actually celebrating their 40th anniversary this year, is something that has worked really well globally in terms of track record. It's very differentiated in terms of the returns stream that it generates to the benchmark. And what does that again mean? I will try and explain this in English as much as I can, right? So when we say it's a differentiated return stream, it means that the correlation that it can have, how similar it looks and behaves to other funds in that category, typically can be very different, right? And we have backtests that we have to actually validate that. So that's really important from a customer perspective. And the way it gets to that is to a very different way of actually building the portfolio. So here we are using data, firstly, a lot of data. So there are over 400 data points for each stock, and the universe covers nearly 1,000 Indian stocks.
Okay.
And that data can then be processed through Aladdin to come up with insights on any benchmark, right? And for the first fund that we're going to be launching, we have gone with the flexi cap approach. So that's what we're going to be doing first, but we can do many of these going forward. And the fund managers are able to set, let's say, the right parameters of how they want to use the data with regards to a flexi cap benchmark and the kind of returns that they want to generate with regards to the flexi cap benchmark, and also where do they want the alpha to actually come from. Right. Even that can be specified. So in this case, the fund managers are choosing this fund will be generating alpha from security selection. So they can then mitigate any other risk that the fund might be taking, whether it's sectors or factors, that can all be minimized and really focus on generating alpha through security selection. The fund manager is able to specify all of this information along with the actual insights, put it into Aladdin. Aladdin has, the risk model, so all of the Indian market exposures are built in the risk model. It has a transaction cost model, as I already talked about, and it's able to run an optimization to produce an output to the fund manager to say, here's a recommended list of stocks that I think meets the criteria of everything that you've given me. The fund manager then is able to look through line by line for each of those stocks and say, okay, yep, this all makes sense, and then they can go and trade that stock. So intuitively, this combination of data, we use some AI in there as well as Aladdin, which is the technology, acts as what? Acts as, you can think of it as an army of analysts that are crunching data. So human beings aren't able to process that amount of data that quickly. So it's able to do that. And then it's able to provide the fund manager at the end with insights and recommendations on a much broader set of stocks. Because if you think about, let's say, a more traditional approach, processing that amount of data on that number of stocks is just not something that is possible for a human brain.
Right.
So here you're able to do that with the help of data and technology, and it's powered by, obviously, Aladdin, which is our technology, and allows the fund manager to then say, okay, I want to be generating or creating a portfolio with, let's say, 100 stocks to try and generate an outperformance on a flexi cap benchmark. So that's the, let's say, the process behind how we are integrating our technology into our investment style.
Got it. So I'm pretty curious here, like when active funds can generate these kind of alphas, then why do we need passives in the first place? Like, why is it active and passive, as you say?
Yeah. So I think one of the very important concepts that I think I'm seeing more and more of here, but I think there's still a long way to go, is the concept of asset allocation and thinking of individuals' portfolios, right? And I think rather than thinking about it as a single stock, single fund, one fund's alpha level. I think it's about the asset allocation. And I think when you think about an individual's asset allocation, firstly, no individual has the same asset allocation. So depending on where they are in their life, what their goals are, everything going to be different. And there will be elements of that can be, let's say, more efficiently gathered through an index fund.
Got it.
Right? So you could, let's say for theory, say, okay, I want to have equity exposure, and for a certain part of my equity exposure, I really just care about the market. So let's say large cap, for example, and there's an index fund. Or I might say in this scenario, I only care about getting overall small cap exposure rather than any single stock exposure. So there are very efficient ways to get market exposure, which are quite valuable from an asset allocation perspective. Because the amount of, let's say, alpha that you can generate if you get the right asset allocation will override any alpha that you can generate at let's say, a single fund level.
Right.
So I think that's in that context when the mix of index as well as active makes a lot of sense. Because you can then say, okay, here's a section of the asset allocation that is just index, and then here's the rest that is active.
So what would you recommend a commoner to have in terms of split in their portfolios in terms of active and passive? 50-50, or how should it be like?
Well, firstly, I'm not an advisor, and to the point I made before, each individual's asset allocation is different.
Got it.
Right? And I think it is not about now, yes, we might launch some funds in the future that will have a recommended asset allocation that we would recommend, but I think it all depends on the individual. And I think that's where some of the other elements of the joint venture that we're doing will play a bigger role in terms of how do you customize that asset allocation. Because depending on who the individual is, where they are in their state of life, it's going to be different.
So how was this investment process of active fund management fine-tuned for Indian market needs? Like I'm sure you would have had that process set in place in the UK or in the other markets, but how about India? How was this fine-tuned?
Yeah, absolutely. And it is, I would go beyond fine-tuned, I would actually say built, right?
Okay.
Because it's not just about fine-tuning.
Okay.
Now, two things there. One is that this process for the active fund that I talked about, so systematic active equity, as I said, has been in place for 40 years in global markets. India is part of that global market, right? So we have been running these strategies in India as part of a global exposure at BlackRock. So that's step one. However, for what we're doing here with the joint venture, it has actually been built. So the signals that are being used are customized. So it's obviously a part of the overall universe, but customized to what works in India, firstly. I talked about the risk model already, which is very important, right? I think when you move into a systematic investment style, you're starting to move away from single stock picking to thinking about it more as an overall fund concept. So which means you need to think about risk, which means you need a very strong risk model. So the fact that in Aladdin we've got an India-specific risk model that has been built for the joint venture is also very powerful. And more importantly, the people. Okay. Right, so that's important because this is not a black box, everything goes into a machine and portfolios that come out of the machine. As I explained, like the fund managers are involved in every step of the way here, in addition, right? So we have, our CIO Rishi, who's been in Indian markets for many, many years, and the local team as well. We've hired a mix. We've got local fund managers and dealers. We also have people that have come from BlackRock that have an understanding of, this investment style. So we've really made sure that the combination of the data that we're using, the parameters like the risk model, transaction costs are all customized for India, and then we have the people here and the local team.
Got it. So speaking of the process as well, I read one of the blogs on your website which talks about the SAE approach, wherein, like, say for example, I think that was precisely the example used, that if the sales of a particular clothing brand is increasing, the stock may rise before the results come because people are trying to capture that through Google Trends and other technologies. Yeah. Can you tell, taking this particular example, how will you evaluate a clothing brand if you see a spurt in their sales growth, and what all factors will you be using in active fund management?
Yeah, absolutely. Look, I think firstly, the fact that we now have so much data, I think that's the big, I would say, delta from, let's say, 10 years ago, right? So we have a lot more information on companies. And in India, again, I'm talking in India, right? And whether it is structured data, like your financial statements, et cetera, analyst earnings revisions, all of that continues to be there. That's getting more and more structured, more and more automated. That's great. But there's also a lot of this unstructured data that you've talked about. And as you say correctly, there is insight from there. So whether it is looking at analyst trends, whether it is even looking at credit card swipes, for banks, you can gather information on a much faster, let's say, cadence. And all of this is available, right? It's all public data that is available. Now, the real challenge is to firstly consume the data and process it into insights, right? Because what you also don't want to do is, let's say, pick up one anecdotal or one signal and just weight everything on that, right? Because it could work. Sometimes it's a leading indicator, sometimes it might not be. So I think the real, let's say, secret sauce is having a huge, let's say, library of data and insights, and then having the understanding plus the technology to be able to process that and actually weight it in the right way to say what matters when and what matters for which kind of strategy. All of these are equally important. And I think that's where SAE, the fact that it has been in place for 40 years, has learned a lot in terms of how, from a mathematical perspective, we should be looking at it, how from a technology and AI perspective, we should be looking at it. There's a lot of learnings that, we have incorporated into our strategy. So in a nutshell, there's tremendous amount of information that can be gleaned from unstructured data, but the key is to have the infrastructure and the technology and the know-how to use it properly.
Got it. Can you just tell, for example, in this case of a clothing brand only, what all parameters are going to be looked at before buying it in your portfolio?
Again, for something like this, right? And I know you've taken clothing as an example. There are many, right? There will still be the traditional, let's say, elements that you look at.
Right.
Whatever is available in public data.
Right.
But we could look at things like, yes, analyst sentiment, much better ways to understand how are others thinking about the brand, firstly, from a, let's say, financial community perspective. There's multiple ways to do that. And then unstructured data is what you're talking about, which is, what are the sales looking like? There are places that you can get that from publicly. Trends in terms of, how is that doing relative to everyone else?
Got it.
Right, that's also important because a lot of what we do here is what we call cross-sectional, right? So what we don't want to do in something like this current FlexiCap fund is to look at some data and then bleed in, let's say, sectoral views. But we also have to look at, if you're looking at a specific company, okay, how is that doing relative to other companies in that same space? Because that's what's important for this fund. So that's the kind of insight that we're going to be looking at as when you are looking at unstructured data and trying to make calls on one company versus another. That's how you need to look at cross-sectional. If you're actually looking at sectoral trends, which we might do in another fund, then you actually want to look at, okay, how does all this aggregate at a sector level? And what does that make it look versus other sectors or other industries? So that's kind of how we look at it.
Got it. So by far, I think 8 of your funds are already live and you're going to go ahead with the FlexiCap fund as well.
Yeah.
So can you tell me in terms of the product pipeline, what is there for the next 12 months?
Yeah, sure. And I think let's say the first wave of funds that you have seen already should give you a very good idea of, let's say, the broader strategy, right? So if I can explain that, we started with the cash funds, which are primarily for corporates and institutions. Those are the players that use these funds the most for their liquidity needs, right? Yes, we are very happy to see retail participation in those funds as well. That's fantastic. But that's the kind of the corporate client base that typically uses those funds. Then we launched the index funds. Again, they were the core building blocks to the point that I made earlier of what you need to do a full asset allocation. Index is still a growing part of the market, but we're starting to see participation across both institutional and retail on index funds. And we're now launching the FlexiCap, which is the more, let's say, predominant retail category that exists in India right now. So that's how we are addressing the different client segments. So as I said at the very beginning, it's all about segmenting the clients and delivering what is right for the client at that point in time. So we will continue over the next 12 months, continue to build our offering for the institutional segment. Now we have clients that we're talking to. We are understanding from them what are their needs. So how do we build up? Those typically, the way the setup is right now, will probably tend to be more on the fixed income space. So you will see more coming in that space. On the retail, more blend of active and index strategies. We still haven't expanded our wrapper offering, and by wrapper I mean we've started with just mutual funds. We will be looking at ETFs in the coming year as well. So all of these are really sharply focused on how do we address our client segments, where are they actually looking at, and what are the differentiated ways to address their needs. And that's the plan for the next 2 years.
So you'll be coming up with sectoral and thematic funds as well in the coming 12 months. Is there any plan?
Yes, is the short answer. And I think, again, within each of those categories, because that is a very broad category, we are really looking at, what is going to be our edge, what is going to be differentiated in that category. So that's a very large category, and absolutely we will have something to offer in that category.
Got it. So if you look at this data point that among the top 750 stocks in India cover 95% of the total market cap in India, right? Mm-hmm. There are more than 1,000 mutual fund schemes to cater to those needs. Do you think that it is too complicated at present?
I actually feel the opposite. Okay. And I'll explain why. I actually think there's some concentration, but actually the breadth that we have here in India is fantastic in terms of the variety of stocks that we have in the market and the various industries that these stocks are coming up in is very well diversified. And I think that is really important for the health of the overall market. That's fantastic. So you're not really concentrated in one or two sectors like some of the other markets in the world. But also very important for a systematic active investment strategy like ours. Because the more breadth you have, the more, let's say, levers the data and the analytics has to express views, active views. So I think that's great. And I also see the depth increasing, right? So, and the depth is all about liquidity. So these stocks, so there's more stocks coming, and they're getting bigger and bigger, and they're getting more and more, they're trading more and more. So when the depth increases, that means then you're able to transact again with lower market impact, lower transaction costs. So all of these are positive trends. And I think as the market grows and evolves, this is really important to build the right breadth and the right depth in the market for overall market health, ecosystem health, but also for the strategies that we have come to market with. These are super beneficial trends.
Got it. So like we were saying, this data point, 750 stocks, over 1,000 mutual fund schemes. So what exactly in terms of index funds are you going to provide? So one thing was that you have lower cost of acquisition. Second is that you're going to focus on the tracking error. Can you tell me how much would be the tracking error currently in the market, and what are you targeting? Like, is it half of that, 30% of that, 60, 70% of that?
So look, the funds have just launched, so we don't want to be commenting on, tracking error of our fund versus the other fund, but I'll talk about it in principle. So there's two things that are very important. Tracking error is very important because it's, let's say, a metric that people should start looking at with a sharper lens. Equally important is tracking difference, and and we are very, very paranoid about both, right? How closely we track both metrics. Because tracking error for us is a ex ante before the fact. Okay, what do we expect? And a tracking difference is what actually happened. And tracking difference is where the transaction costs, the TERs, all that comes into play, and that is actually the difference in return that you get in investing in the fund versus looking at the screen of the index, right? So minimizing that is huge focus for us. And the ability to do that, typically you would associate as you scale up, you are in the market more, you're able to access pools of liquidity more, you would want to be able to reducing that tracking difference more and more. I think we have started that from scratch. So even from zero, when we launched, that's been our primary focus. Because the objective for the end customer when they invest in an index fund is two things, like it should be two things. How much am I paying to get it? And how close to the index return am I getting? Those are the only two things that matter. Yes, the consistency with which we deliver both of those will bring trust, will bring more people in. I think that's important. And then the second order objectives of that, once you've gone through, let's say, the first step, is what other exposure. So I think that's where we are looking at next, is that there has to be, let's say, a core offering of exposures, and we've already started with that. But then what are the other ways to, let's say, access the market through these cost-efficient vehicles is something that we're spending a lot of time looking at, whether it is through, sectoral, thematic, smart beta, all of that we should be looking at, and we are looking at.
Since we're talking about index funds and you're not even having regular plans as of now, so do you have any plans of leveraging partnerships with RIAs or other advisors?
Yes, and we already are. Okay. So that's already in place. As I said, the ecosystem that we are working with right now, we have our own ecosystem. We are within GeoFinance, we are within MyGeo. We have partnerships with digital platforms, and we're already working with RIAs, right? Because again, with direct plans, they are the ones that are able to advise on direct plans, and we already have that in place, and we look to grow that partnership as well.
Got it. Do you want to explain further on this partnership, like what all have been done until now, and what is there in your plans?
So we approach RIAs the same way as we would any, let's say, major client, right? Is that what is the need that we're looking to fulfill? So as the RIAs are advisors to their end customers, and they have a full, let's say, suite of funds to choose from. So what is it that we can offer them that is differentiated? And why does it make sense for them to then advise on the fund from a portfolio context, right? So whether it is the price at which they are getting the exposure, that's one way to look at it, or is it a very differentiated and unique exposure? So I talked a little bit about the FlexiCap fund, which behaves very differently to the other FlexiCap funds out there. So that is how we engage. And again, we are at early stages of our launch. So we're also looking to ideate with the RIAs and maybe co-create some products with them as well.
Great.
So it's a very, let's say, a fluid conversation that we have with RIAs.
Got it. So if you look at the US market, more than 50% of equity assets are in passives, right? And while if we talk about India, they have just grown, and that too in the late teens currently. Why do you think India hasn't been able to catch up to the speed of other developed markets in terms of their share in passives?
Yeah, and I think it's not a question of speed. I actually think it's just a question of a point in time where we are, because actually the speed with which passive has gone from 5% to now almost 20% is actually pretty impressive, right? So I think it's a question of where the starting point has been, and now where are we with regards to the markets. And I think the trend that is in place now is very encouraging, very positive. And the more and more the markets mature, investors start understanding and appreciating, okay, I can get market exposure through an index fund at a price point that's a lot lower than an active fund. So maybe for a part of my asset allocation, that's all I want. This is exactly what's happened in the US and the UK. So again, there is still a very robust active market in the US, in Europe, UK, everywhere. But the asset allocation of, let's say, the individuals has become active and index rather than one or the other. And that's been the big change. And I think that can and will happen here over the next few years as well. And I think knowledge, understanding is one. I think also as markets mature, right, let's say the returns that people are getting on a total return basis start getting to a more, let's say, steady state mature level, because those have been very, very high in India over the last sort of 3 to 5 years. Then you start seeing more of a, let's say, appreciation of, okay, at that level of total return, how much am I actually paying in terms of fees? So can I get, let's say, an index-like return for much lower fees? And that's what we've seen in other markets, and that what could happen here as well in the next few years.
So if we talk about Indian data, almost across all categories, the active funds have not been able to beat their benchmarks, more than 50% across almost all categories. This has been the case in the US as well. Why do you think this happens?
Yeah, look, I think, and this is all academic, right, as well. So it's supported by papers in all markets that on the overall average, over a longer term, this is what happens. So you end up getting the index return, which has been fueling, let's say, the rise of index globally, right? Again, that doesn't mean active doesn't work, because you still have managers that are outperforming their benchmarks. There are still segments of the market that can still generate alpha fairly consistently. So to me, it reaffirms kind of the statement of active and index, really, because if you want to be in a situation where, let's say, you don't want to think about manager selection, picking the right manager, because what if I get it wrong and they are in a, let's say, a downward trend from their returns perspective or the alpha generation perspective, then those people might choose to just go with index funds. Whereas there will still be people that will say, no, I have an allocation, but I still believe that I can get additional returns on top of that, and there will be room for active as well. So I think just looking at it at a, let's say, an average level could lead to those kind of conclusions, but the fact of the matter is that even within that average, there's going to be outperformers and underperformers. And if you have skill in picking that right, then people might choose to do that.
So coming to our last set of questions, it's been a pretty interesting conversation so far. Speaking of your 2030 vision for the Indian mutual fund industry, where do you see the passive penetration going, the mutual fund penetration as a percentage of total population going, the SIP book, and how does JioBlackRock fit in over there?
Yeah, I think, and I talked about this before as well, at 2030, I can easily see the overall industry being more than 2x of where it is right now. Okay. Right? I think and that's a combination of both flows as well as market moves, all of that put together. So more than double of where we are right now is something that I have high conviction around. I don't want to put a percentage of what index is going to be as a percentage of that. Like I said, we're already at 20. I think we'll be higher than that for sure. I think that's a trend that is here to stay. So we're going to be higher than where we are right now. So if you put that together in terms of the overall increase and also the percentage increase, that's a lot of index assets coming, from here on. So I think that is super encouraging for all of us here in the industry, and that's kind of how I look at it. Yeah, and SIP penetration is again, the trends are very positive. That continues to increase, and I think what we are seeing, especially even in the last year, where you have had a year where the market has been flat to slightly down, depending on which index you look at, and that trend continues, right? So the people are still, the fact that as an investment behavior, the SIP is becoming more and more accepted is a very good and healthy sign. So people getting the concept of time averaging, cost averaging into the markets being a good long-term investment strategy, that is phenomenally powerful, right?
Got it.
So we are huge supporters of that. We want to work with the industry. We've already launched with our SIPs at 500. So as much optimization we can do, we want to work with the industry on making that a more and more powerful tool for investors here in India.
Got it. So since you have a lot of global experience, do you have anything in mind that should come on a regulatory change front in India for the Indian markets?
The way I approach that is every market has its own unique regulatory landscape for a reason, because every market is different, right? So the way we are, and we have just, let's say, launched, so we have just started to work on the landscape with the regulator here and with the industry bodies. So our view is we will want to bring in some ideas from our experience and from my experience in global markets. But then they have to be adapted and made fit for India. Because you can't lift and shift something that, let's say, has worked in the US or the UK and say, well, okay, let's just do that in India. That's not how it's going to work.
Right.
So really engaging with, AMFI, with SEBI, is going to be a core part of what I do, what JioBlackRock does in ensuring that the overall market is evolving. And so far, that experience has been very positive.
Any closing note that you have for our audience, which largely consists of informed investors and qualified financial advisors?
Well, firstly, thank you for having me. This was a great conversation. And my closing note would be we are excited to be here, be a part of this ecosystem. I think there is tremendous potential for this industry. And we are here to help grow that and be a part of that, and look forward to more of these interactions going forward.
Great. It was great having you. Thank you so much for your time.
Amazing. Thanks for having me. Cheers.